Warren Buffett is widely known as the greatest investor ever, and with a company like Berkshire Hathaway, a large and successful conglomerate, who can argue with that? But what if I told you that once upon a time, Berkshire was a lousy business and wasn't run in a way that would allow scalability, and that this was so until an extraordinary man came into the picture and changed everything? Who was that man, you may ask? That man was none other than Charles T. Munger, better known as Charlie Munger. Welcome to The Eighth Wonder, a channel dedicated to making compound interest your best interest. Charlie Munger is the vice chairman of Berkshire Hathaway and Warren Buffett's right-hand man. He joined the company in 1978 and has been instrumental in growing the company to the large conglomerate that it is today. Warren Buffett might not have become the incredible investor he is known as today if it weren't for Charlie Munger. Buffett famously transitioned from buying the cheapest businesses he could find, known as cigar butts, to buying quality businesses. He largely came to make this transition because of Charlie Munger. Early in his investment career, Buffett was largely influenced by Benjamin Graham, who was one of the best investors of his time and his mentor. He's also the author of the famous investing book, The Intelligent Investor. Ben Graham was adamant about ensuring that you don't overpay for a company and that you have a large margin of safety, which frequently led Buffett to buy inferior but cheap businesses. It took someone as wise as Charlie Munger to open Buffett's eyes to the profits to be made by paying a bit more for the highest quality business. Here's Warren explaining how the approach he had been taking wasn't the best.
The biggest, but buying Berkshire Hathaway itself was a mistake because Berkshire was a lousy textile business, and I bought it very cheap. I'd been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. It's disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But in those days, I was buying cheap stocks. And Berkshire was selling below its working capital per share. You got the plants for nothing. You got the machinery for nothing. You got the inventory and receivables at a discount. It was cheap. So I bought it, and 20 years later, I was still running a lousy business, and that money did not compound. You really want to be in a wonderful business, because the time is the friend of the wonderful business. You keep compounding, it keeps doing more business, and you keep making more money. Time is the enemy of the lousy business. I could have sold Berkshire, perhaps liquidated it, and made a quick little profit, one puff. But staying with those kind of businesses is a big mistake. So you might say I learned something out of that mistake, and I would have been way better off taking what I did with Berkshire is I kept buying better businesses. I started an insurance business, See's Candy, the Buffalo, all kinds of things. I would have been way better doing that with a brand new little entity that I'd set up rather than using Berkshire as the platform. Now I've had a lot of fun out of it. I mean, everything in life seems to turn out for the better, so I don't have any complaints about that, but it was a dumb thing to do.
Moving away from his old style of investing wasn't always easy, which is why Charlie was so invaluable in helping bring about that change. It is highlighted in this video with Warren Buffett and Charlie Munger.
So, Charlie, where did this thinking about investing, that you don't buy cheap bargains, but you look for really good companies, come from?
I have a habit in life, which is I look at it and I observe what works and what doesn't. And I'd seen so many idiots get rich in easy business. So
Charlie,
naturally I wanted to be in an easier business.
Charlie, it was very interesting to me when I first met Charlie. He had a number of clients. His father had a number of clients. And he had thought about the businesses of each one of those clients probably in a much more perceptive way than most of them have thought about them themselves. I mean, he was incapable of not thinking through what the realities of the situation were, and what could be done about it, and he just analyzed things.
What would work and what wouldn't and why. It's so simple.
So what are a couple of those early investments that were reflective of this new philosophy of buying really good companies?
Well, in terms of stocks, something like American Express would have been that had gotten some trouble, but it was a wonderful business. And there were some others that, in terms of buying the entire business, I probably didn't realize what a wonderful business our first insurance purchase was, but I knew it was a good business. The first real business we bought that way was See's Candy. I mean, it was really an outstanding business, and I still had enough elements from my past that I really didn't want to pay the last few $1 million. And
Few million, you didn't want to pay the last 25,000.
Yeah. And Charlie reminded me that I was slipping back into the Stone Age again, and got me to move.
Over the years, Warren and Charlie have formed a formidable partnership, and Warren has never shied away from heaping praise on Charlie. And in his recent letter to the shareholders of Berkshire Hathaway, he took time to share some quotes from Charlie, and I would like to explore some of them and discuss what we can learn from them. In a section of the letter titled, "Nothing Beats Having a Great Partner," he starts off by saying, "Charlie and I think pretty much alike. But what takes me a page to explain, he sums up in a sentence. His version, moreover, is always more clearly reasoned and also more artfully, some might add bluntly, stated." Here are a few of his thoughts, merely lifted from a very recent podcast. Number 1. The world is full of foolish gamblers, and they will not do as well as the patient investor. This is a point I personally agree with and have brought up a few times in previous videos. It is said that the market can remain irrational longer than you can remain solvent, meaning that trying to predict where the market will go will always be a futile exercise that will leave you disappointed and running a huge loss. On the other hand, by being patient and investing in good businesses, you'll make great returns over time. What you put your money into should not be driven by what the most trending stock is and the desire to see quick results. This approach will put you at a greater risk of losing it all as opposed to a well thought out investment for the long term with great earning potential. The kind of track record that Warren and Charlie have is a great testament to this principle. Over short periods of time, there are some investors who have outperformed Berkshire, but over the long stretch, Berkshire always comes out on top. Number 2. If you don't see the world the way it is, it's like judging something through a distorted lens. This analogy applies not only in the world of investing, but in life in general. We need to see things for what they truly are in order for us to see their true value. If you don't learn and understand how the market works, you'll never really get the most out of it because your reality will be a distorted version of what it is. If you don't see your investment as owning a small part of a business, then your vision of what you're investing in might be distorted and might need some work. A stock is more than some arbitrary thing whose price is supposed to go up all the time. Number 3. All I want to know is where I'm going to die, so I'll never go there. And a related thought, early on, write your desired obituary and then behave accordingly. This is a very interesting point. It can apply in so many ways depending on what you would like to achieve. By knowing what things to avoid, you can save time and avoid potential losses. Similarly, by setting goals and knowing what it would take to reach them, you pretty much have a recipe to follow. All that's left is for you to do the work so that the recipe can come to life and you can benefit from it. Set goals for what you would like to achieve through investing, learn what it would take to get there, and then set out working towards that goal. Number 4, if you don't care whether you're rational or not, you won't work on it. Then you will stay irrational and get lousy results. One of the biggest things that Charlie and Warren often address is knowing and operating in your circle of competence. This means that they know what they're good at and they stick to the things they know because that is where they can provide the most value. We can benefit from understanding our own circles of competence and our mindsets so that we can work on the things that need improvement, which in turn can provide value. If you are driven by emotion and not reason, then you are irrational and that will affect the kind of results that you will get. Fortunately, this does not have to be a permanent thing. You can learn from your mistakes and improve. Number 5. Patience can be learned. Having a long attention span and the ability to concentrate on one thing for a long time is a huge advantage. There exists in the minds of many the idea that unless we can see instant results, then whatever we're working on is not worth our time and efforts. While this may be a common trait among people, it can be done away with. One of the simplest ways we can learn patience is by learning and practicing. You can learn from people like Charlie and Warren, get to understand what it is that allows them to be so patient in what they do, and over time, as you practice, you will make better decisions because you will be well informed and trained. A great company keeps working after you are not. A mediocre company won't do that. The whole idea of investing is eventually to have your money work for you. But where does the money work for you? In a business, preferably one that has a competitive advantage and is well managed. This makes it more likely to continue running for a long time, thus helping you generate passive income. Companies are run by people. That's why you need to understand what the people in management are doing, what is the long-term goal, and what is the plan to make that dream a reality. Look for great companies and invest in them for the long term. That is essentially what Berkshire does, and that is what Charlie has brought into the business that has made all the difference. Number 7. Warren and I don't focus on the froth in the market. We seek out good long-term investments and stubbornly hold them for a long time. In times like these, where there's a lot going on in the markets with a lot of uncertainty, people will often panic and make irrational decisions. By focusing on the long-term performance of the company and not the short-term, you get to understand that what is happening now most of the time only affects the now, but not so much the hereafter. We can avoid a lot of the pitfalls that many will fall into and instead enjoy even greater returns on the other side of the situation by taking the long-term approach to investing. It is said that time in the markets beats time in the markets. And what better example can we look for than Berkshire Hathaway itself? Number 8. Ben Graham said, "Day to day, the stock market is a voting machine. In the long term, it's a weighing machine. If you keep making something more valuable, then some wise person is going to notice it and start buying." A lot happens on the stock market every day, but just because such is the case, it does not mean that you also need to be actively working on something every day. By looking for good businesses with a long-term value, you'll be far better off than someone who's actively trying to beat the market every day. The purpose of businesses going public is to access outside capital and make enough profits to be able to satisfy investors and keep the process going. The more value a company provides, the more attractive it becomes to investors. Your duty is to be that wise person who sees the value earlier so you can ride the wave of profit for longer. Number 9. There's no such thing as 100% sure when investing. Thus, the use of leverage is dangerous. A string of wonderful numbers times 0 will always equal 0. Don't count on getting rich twice. To me, this speaks to speculation and greed. These two things, in my opinion, should be avoided at all costs, especially when it comes to investing. I've said before that investing is not a get-rich-quick scheme. So if you start taking up some crazy risks and even think of leveraging in order to get maximum results, you can run a huge risk of losing it all, and that is definitely not something you want to see. It's interesting to hear someone with such a great track record say that nothing is 100% guaranteed. Risk is a factor of investing that you'll always need to be aware of, and try to mitigate it as much as you can is a good idea. Number 10. You don't, however, need to own a lot of things in order to get rich. This is a classic Charlie Munger philosophy. With a portfolio of no more than 5 holdings most of the time, he keeps things simple, buys in great companies, and just enjoys making his money that way. I guess you can say that he believes in diversification a whole lot differently than most people do, which works and helps him focus better than he probably would otherwise. The next 2 points I'll put together, which are number 11, you have to keep learning if you want to become a great investor. When the world changes, you must change. And number 12, Warren and I hated railroad stocks for decades, but the world changed and finally the country had 4 huge railroads of vital importance to the American economy. We were slow to recognize the change, but better late than never. In the beginning, I talked about how Warren had to change his investment strategy in order to become as successful as he is now. This is a natural thing that can, and might I say, even should happen in our lives. The world is constantly changing, and if we are not willing to learn and adapt, then we will get left behind. I liked how Charlie admits that him and Warren were late to the party when it comes to investing in railroad stocks, but eventually caught on and got a slice of the pie. One of the largest holdings in Berkshire right now is Apple, a tech company, something that both Charlie and Warren were never fan of, but have come to recognize as a company that aligns with Berkshire's way of running a business, which made it a great buy. This to me means that it's okay to change and adapt, and that it's not too late for those who haven't started. As the saying goes, the best time to plant a tree was 20 years ago. the second best time is today. To conclude the section on Charlie Munger in the letter, this is what Warren Buffett had to say. Finally, I will add 2 short sentences by Charlie that have been his decision clinchers for decades. Warren, think more about it. You're smart and I'm right. This is one of those quotes where Charlie's quick wit is displayed. He's very wise and very funny too. He has a way of addressing issues in a very straightforward but funny way, and this is one of the things that makes him such a fun, lovable character. He uses a lot of humor to teach a lot of truth. Warren concluded by saying, I will add to Charlie's list a rule of my own. Find a very smart, high-grade partner, preferably slightly older than you, and then listen very carefully to what he has to say. Let's be honest, a partner like Charlie Munger may be a rare one to find, but in a world where Charlie already exists, why not just learn from him? He may not be your partner, but his lessons can benefit you greatly. A simple way that you can use in order to learn from Charlie, Warren, and many other great investors is by subscribing to this channel and clicking the notification bell so you stay informed whenever new videos are uploaded. I hope that you found value in this video and that you learned something new. To show some appreciation for the work that went into putting this video together, please leave a like and share the video with a friend. What was your favorite part of the video? Comment below and let me know. Thanks for watching. Hope to see you on the next one. But until then, stay invested.